Everyone knows that investing is important. But at the same time, for somebody who's new in the markets, being told to go and build a portfolio can be a really tricky thing. It's as if saying that I've never cooked before, but you want me to prepare a gourmet meal? But if you had ambitions to do it, hey, I'm here to help you today with the video just for that. But it's not really about cooking a 10-course gourmet meal. Think of it more as trying to help yourself prepare a simple roast chicken with salt and pepper and maybe a little bit of a side salad. I'll start by clarifying what does I mean when I say long-term and easy ETF portfolio. Talk a bit more about that approach. I'll give you 3 exact examples of those portfolios themselves, talk a little bit more about the drawdowns, the long-term annualized gains, and on top of that, the cost as well. Hey guys, it's Sunmin and welcome back to Your Money Game, the show where we'll get better with saving, spending, and investing. Firstly, and most importantly, easy portfolios does not necessarily mean it's a low-quality portfolio. Not many people know this, and especially me when I first started in the markets. But for regular investors, it's actually very difficult to beat the average index when it comes to picking individual stocks. There's plenty of research out there that shows that even professional money managers, the majority of them can't even beat an index like the S&P 500 over the long term. And remember that these guys are living, breathing, eating stocks on a daily basis 24/7. But my point is, if you've been told that that's the only way to find success in the stock markets, that's not necessarily true. My next point is that getting a stable start in investing is really important and I think really underrated. Easy ETF portfolios are a great way to start without too much price volatility that can really play on your emotions. They're designed to be long-term and not actively traded. And this is a personal view because when I started exactly the opposite. I traded actively, I won some money, but I lost a lot more money, and on top of that, I lost more time. The emotional roller coasters themselves were tough, but with all the time lost, I can never regain it. My next point is that with these type of portfolios, it's very easy to grow from here. If your interest in investing grows and you deepen your level of understanding, you can choose to kind of layer more investments on top of this core portfolio. And this is a fairly common approach called core and satellite, where if you believe you have a very stable core portfolio, over time, if you're interested and have high conviction in certain other things, you can add them as satellites to your investments. And on top of it all, there are 2 cool benefits of using this approach. First is that they tend to be relatively low cost. Many people don't factor in fees when they're thinking about their investments. And on top of that, when it comes to active trading, if you're not with the right broker, you might end up spending a lot of money in those kind of transaction fees. The other kind of fee is when you compare using a low-cost ETF versus an actively managed fund, which tends to be much more expensive. As an example, a low-cost ETF can be really cheap, like 0.03%. which is basically like $3 to manage $10,000. In contrast, an actively managed fund like a unit trust can cost as much as 1.5% on an annual basis. That's $150 to manage that $10,000 portfolio. And I know it might not sound like a lot right now, but trust me, as your account size grows, over time, it all adds up. The second benefit is that these portfolios are designed to be easily maintained. Once you set them up, you simply need to invest in them consistently over time, and that's pretty much it. Maybe every year you kind of try and rebalance it, which basically means buying and selling some of the underlying assets to get back to the original ratios. And it's also really easy to just take a little bit of time to click that like button, because that really tells the gods of YouTube that, hey, this is a great video, share it out to more people in the world, and that's just how the YouTube algorithm works. So let's start with the easiest of the portfolios, which is a 2-fund portfolio that was introduced by J.L. Collins. He's a pretty popular figure in the financial independence, retire early community. As a former professional investor, he's seen the ins and outs of the industry, and on top of that, grew to appreciate why index investing as an approach is really the best way to do things. I really recommend that you check out his book, The Simple Path to Wealth, because it's a very easy read and you can kind of dig into it and understand a bit more about the philosophy of low cost and passive index investing. So the 2 ETFs that it holds are VTI, which is the total US stock market, as well as BND, which is the total bond market, and the ratio is 80-20. So if you had $10,000, $8,000 would go to VTI and $2,000 would go to BND. Assuming you've reinvested all your dividends and you rebalance annually, your 10-year annualized returns would have been 11.5%, which is really respectable. Its worst drawdown, which is basically a fall from the top to the bottom, was 38%, and that was back in February of 2009. And in March of 2020 last year, your drawdowns would only have been 15%. Assuming you had $10,000 invested in this portfolio, your annual cost to manage it is only $3.20. So this expense ratio is 0.032%. It's cheap. Now, this super easy portfolio makes the bet that the US markets are going to be the top performer over the long term as well. The next popular portfolio was introduced by a group called the Bogleheads, and they are basically followers of this guy called Jack Bogle. Now, he is credited as being the father of index funds, and on top of that, being the founder of Vanguard, one of the biggest money managers in the world, managing $6 trillion under management. And that's trillion with a T. So the Bogleheads are people who are just adopting his style of investing, and they have a really active forum online, which is a great resource if you really want to dig into it and kind of find out more about investing. So it's a 3-fund portfolio, which basically adds one more ETF on top of what the JL Collins portfolio had. And that's the Total World ex-USA ETF. And it's called VEU. So the ratios are 50% towards VTI, 30% towards VEU, and 20% to BND. And ex-USA simply means that in the total holdings, they have removed America as part of their market. Its 10-year annualized return is 9.16%. And this was achieved with the maximum drawdown of 43% during February of 2009. In March of 2020, its drawdown was about 17%. With a $10,000 portfolio, your annual management fee will only be $4.70 or 0.047%. Cheap. And the thinking of the portfolio is fairly simple. You still believe in the power of the US markets, which is why 50% of the portfolio is allocated that way. But on top of that, you've got 30%, which is fairly distributed and well diversified across the rest of the world. The last popular example I wanted to share has a pretty cute name. It's called the Golden Butterfly Portfolio. Wow. And the reason why I included it here is that I think it's a comfortable leap forward in building a little bit more of a sophisticated portfolio. If you thought of the previous 2 portfolios as being a simple salt and pepper baked chicken with a little bit of a side salad, this portfolio, it's as if like you're adding much more interesting spices, and on top of that, maybe using a better salad dressing. I have no idea whether that's a good metaphor, but I hope you're still with me here. So we started with 2 funds, then we went to 3 funds, and this Golden Butterfly portfolio has 5 funds. It starts with VTI, where 20% is allocated to it. It then adds 20% of IJS, which is a US small cap value ETF. Then it's 20% of TLT, which is basically the US long-term treasuries. And then 20% is allocated to SHY, which is US short-term treasuries. And the final 20% is to gold, GLD. So as you can see, this portfolio becomes a little bit more nuanced. And let me explain, because I think it's really important that you understand a little bit more about what is it you're trying to build. So let's start with IJS, which is the US small cap value ETF. The question is why? Why is that so important? Now, it's chosen because it's based on academic research that points to these things called factors. Think of it as just characteristics of stocks that determines how well it does over the long term. And based off that research, small companies, which are small cap, and value, which are relatively cheap, tend to do better over time, which is why IJS is chosen, which are small cap value stocks. SHY, which are short-term treasuries, are chosen because it's an equivalent of cash actually, and TLT are basically long-term US treasuries, which are actively like bonds, which means that at least if the stock market goes down, it doesn't necessarily mean that bonds will follow as well. So therefore, it helps you balance out the performance of your portfolio over the long term. GLD, which is the gold ETF, helps kind of do the same thing. But on top of that, gold tends to be thought of as a good hedge or protection against inflation. The 10-year annualized return for this portfolio is 7.84%. Now, I bet your immediate reaction was like, meh, compared to the rest, this has a sacrifice of about 2 to 3%. Ooh, I don't think that's so great. But get this, the maximum drawdown it experienced was similarly in February of 2009, but the drawdown was only 15%. This is nearly half the amount of what the other guys had when it comes to the drawdowns. And in March of 2020, this portfolio only had a drawdown of 7%. So depending on your personality, you might want that kind of stability. For $10,000 invested, your annual management fee is a little bit more expensive at $19.60. That would mean your expense ratio is about 0.196%. So it's still pretty cheap, but it's relatively more expensive versus the others. So there you have it, 3 really popular ETF portfolios that are simple enough to build and easy to maintain. But where do we go from here? As I mentioned, this is really just the starting point. There are many things you can continue to do and learn as you kind of mature or develop more knowledge. But if you were just starting out, I would really urge you to just don't worry so much about optimization at this point in time. Just get the basics right, get the portfolio going, and then over time, you can begin to swap things out. So build that portfolio, continue to build your knowledge, and then personalize and make this portfolio as exciting as you want it to be. So I hope this video inspires you to take action. And importantly, I hope you got a lot of value out of this. And if you did, I would really appreciate your support in clicking that like, subscribe, as well as that bell button, because I'll be back again next Sunday with a brand new video. And until then, you take care. Keep playing your own game.